In September of 2008, something happened that terrified governments, investors, and ordinary people all over the planet. A company that had existed for more than 150 years suddenly collapsed. Not slowly, not gradually, but almost overnight. Within hours, panic began spreading through financial markets across the world. Banks stopped trusting each other. Investors rushed to pull their money out of funds. Stock markets crashed, and millions of people who had never even heard the name Lehman Brothers suddenly felt the consequences. But the collapse of Lehman Brothers did not begin in 2008. The story actually began decades earlier, in a financial culture that rewarded risk, speed, and enormous bets. Lehman Brothers had started as a small family business in 1850, founded by immigrant brothers who originally traded cotton in Alabama. Over the next century and a half, the firm transformed itself again and again, surviving wars, depressions, oil crises, and market crashes. By the early 2000s, it had become one of the most powerful investment banks on Wall Street. Its offices in New York were filled with traders, analysts, mathematicians, and executives whose job was simple: find ways to turn money into more money, faster than anyone else. The financial world had changed dramatically during the late 20th century. Banks were no longer just places where people deposited savings and took out loans. They had become complex financial machines that created, packaged, and traded enormous quantities of financial products every day. And the biggest advantage these banks had was leverage. Leverage allowed banks to borrow huge amounts of money in order to make even bigger investments. Imagine having $1 and using it to control $30 worth of investments. If those investments rise in value, the profits can be enormous. But if those investments fall, even slightly, the losses can multiply just as quickly. Lehman Brothers embraced this strategy more aggressively than almost anyone. Executives believed that as long as markets kept growing, the risks would remain manageable. For several years, that belief seemed correct. The early 2000s were defined by one powerful economic force: the American housing boom. House prices were rising year after year, sometimes by double-digit percentages. Owning property appeared to be the safest investment in the world. Families rushed to buy homes before prices climbed even higher. Construction companies built entire neighborhoods almost overnight. Mortgage lenders approved loans faster than ever before. And Wall Street found a way to turn those loans into a global investment product. Banks began bundling thousands of mortgages together and converting them into financial securities that could be sold to investors. These securities were called mortgage-backed securities. To investors, they looked incredibly attractive. They generated steady income because homeowners were constantly making monthly payments on their mortgages. Even better, they seemed safe because the loans were spread across thousands of different households. The logic was simple. Even if some homeowners stopped paying their mortgages, most people would continue paying, so the overall investment would remain stable. Rating agencies gave many of these securities extremely high ratings, sometimes even the highest rating possible. Pension funds, insurance companies, and investment funds around the world began buying them. Demand exploded, and Lehman Brothers saw an opportunity. The bank started buying and creating enormous quantities of mortgage-related investments. The more mortgages that existed in the system, the more financial products Wall Street could build around them. Billions of dollars flowed through Lehman's trading floors. Profits surged. Bonuses became legendary. Some traders were earning millions of dollars in a single year. Inside the bank, confidence grew stronger and stronger. Executives believed they understood the system. Models and algorithms suggested that the risks were limited. Housing prices had been rising for years. Most people believed they would continue rising indefinitely. But underneath this success, the foundation of the system was becoming dangerously fragile. In order to keep the housing boom going, lenders had started giving mortgages to people who were not financially stable. Some borrowers had very low income. Others had poor credit histories. Some were even given loans without proving their income at all. These became known as subprime mortgages. At first, these risky loans represented a small part of the market. But as demand for mortgage-backed securities kept increasing, lenders began creating more and more of them. Wall Street needed new mortgages to turn into new investments. The machine had to keep running, and Lehman Brothers was one of the banks pushing hardest. Internally, some analysts started to notice warning signs. If housing prices ever stopped rising, millions of borrowers would suddenly struggle to pay their mortgages. The securities built on those loans could rapidly lose value. But the profits were enormous, and few people wanted to slow the machine down. By 2006, the system had reached an extraordinary scale. Trillions of dollars in mortgage-related investments existed throughout the global financial system. Banks were deeply interconnected through loans, derivatives, and financial contracts. Confidence remained high. Then, Almost quietly, something changed. Housing prices stopped rising. At first, it seemed like a minor pause in the market. But over the next months, prices began slowly falling. And when housing prices fall, the entire logic of the mortgage system begins to break. As housing prices continued to fall through 2007, the first cracks in the system began to appear. Homeowners who had taken risky mortgages suddenly discovered they owed more money than their houses were worth. Many could no longer refinance their loans. Others saw their monthly payments increase dramatically after introductory interest rates expired. Slowly at first, mortgage defaults began to rise. Then foreclosures started appearing across the United States. Entire neighborhoods began filling with empty homes. For Wall Street, this was deeply alarming. The mortgage-backed securities that banks had sold to investors were built on the assumption that most homeowners would continue paying their loans. But as more borrowers stopped paying, the value of those securities started falling. At first, the losses seemed manageable. Financial markets had experienced downturns before, but the structure of the system made the situation far more dangerous than many people realized. Because banks had used enormous leverage, even a small decline in asset values could wipe out huge amounts of capital. Lehman Brothers was particularly vulnerable. The firm had accumulated massive exposure to mortgage-related investments, far more than many of its competitors. And because it had borrowed so heavily, its survival depended on one critical factor: confidence. As long as investors and lenders believed Lehman Brothers was financially strong, they would continue lending the firm money. But if confidence disappeared, the bank could run out of cash extremely quickly. During early 2008, rumors about Lehman's financial position began spreading quietly among traders and investors. Some hedge funds started reducing their exposure to the firm. Credit markets became more cautious. Executives at Lehman tried to reassure the public that the company was stable. They sold some assets and attempted to raise additional capital. But behind the scenes, the pressure was building. Financial losses were growing. Investors were becoming increasingly nervous. And the global financial system was entering a dangerous phase where fear itself could trigger a collapse. By September 2008, Lehman Brothers was facing a crisis that could no longer be hidden. Government officials in the United States began organizing emergency meetings with leaders from the largest banks in the world. They hoped to arrange a rescue that would prevent a catastrophic bankruptcy. One possible solution was for another bank to purchase Lehman Brothers and absorb its assets and liabilities. Negotiations took place at an extraordinary pace. Bank executives, regulators, and government officials worked through the night searching for a deal. But when potential buyers examined Lehman's financial position closely, they hesitated. The losses tied to mortgage investments could be far larger than expected. The risks were enormous. And without government guarantees, few institutions were willing to take them. Eventually, the negotiations collapsed. On September 15, 2008, Lehman Brothers filed for bankruptcy protection. It was the largest bankruptcy in American history. The consequences were immediate and dramatic. Financial markets around the world plunged into panic. Investors rushed to withdraw money from funds that held risky assets. Banks became unwilling to lend money even to each other. Credit markets froze. Businesses that relied on short-term loans suddenly found themselves unable to finance daily operations. Within weeks, companies began laying off workers. Economic activity slowed sharply across multiple continents. Governments were forced to intervene with massive rescue programs in order to stabilize the banking system. Trillions of dollars were eventually deployed to prevent an even deeper global collapse. For millions of people, however, the damage had already been done. Families lost their homes. Retirement savings were wiped out. Entire industries contracted as the world entered the worst economic crisis since the Great Depression. The fall of Lehman Brothers became the symbol of the global financial meltdown. Yet the real lesson of the crisis went far beyond one company. It revealed how fragile the modern financial system can become when risk, complexity, and leverage grow unchecked. It showed how quickly confidence can disappear when investors realize that the foundations of the system are weaker than they believed. And it demonstrated that decisions made inside trading floors and executive offices can ultimately affect the lives of millions of people around the world. The collapse of Lehman Brothers was not just the story of a bank that failed. It was a warning about how powerful financial systems can become unstable when growth, profit, and risk are pushed to their limits. And even today, economists and regulators continue asking the same unsettling question. Could something like this happen again?